Hey traders, David Frost, MyStrategicForecast, here for another episode of Common Sense Market Analysis. Today is Monday, August 12, 2024. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. What do we have on the docket today? Let's look at this thing from a big picture perspective, and then we're going to drill down to a shorter picture perspective, and I'm going to give you my theory on what kind of schematic we're looking at going forward over the next several weeks or so. Let's start with the sell-off and the fact that we were looking for a low in the time frame that the low came in around the end of July, first week of August. The low came in on August 5th. That counts. That was right after a weekend. The Friday before was August 2nd. So for all intents and purposes, came in the first three trading days of August. Now, the question is, and you're going to have the bull-bear debate. The question is, was that a low and the market resumes the uptrend? We'll find the thing at new highs or around the highs in no time at all that stuff. Is that what's going on? Or was this essentially leg A of a multi-leg downturn leading into and around the election period where markets were scheduled to become more volatile? I believe, for what it's worth, it's the latter of the two. I don't think this is over. I think that was the first phase of a multi-phase decline. Okay, fair enough. So what does that mean? Again, let's look at the high, look at the low. Where are we? What have they retraced from the low already in a short period of time? Getting out our trusty Fibonacci retracement tool, we use the high that was made on the 16th of July, the low that was made on the 5th of August, and a normal garden variety retracement at 50% is 537.71, putting price right around an important area. It's right around the trend line that we've been watching for quite some time. Taking it from the monthly chart, we're talking about the upper trend line. It goes from the March of 2000 highs, connecting the highs in 2022. And there we have that trend line that dissects over there. We know about that one if you've been around here for any period of time. Okay, fair enough. Then you have the 618 retrace that happens to be right around the convergence of the 50 and the 20 period moving average and a gap left open when the market broke down at exactly 543.01, just below the 618 retracement. So what can we say about all that? Well, if I blow this up, we could say this box over here between the 618 and the 50% retracement is absolutely, without a shadow of a doubt, overhead resistant. But wait, there's more. Do you have your sticky notes out? You're getting into an on-time type of situation. If you've taken the course Lazy E-mini Trader, the bell will go off. You're coming into an on-time type of situation right around some of these important places. So if, capital I, capital F, if the market is up within that zone, tomorrow, that is an area where we're likely to find overhead resistance. But wait, there's still yet more. What do we have tomorrow on Tuesday? You got it. It happens to be Turnaround Tuesday. You might laugh, you might snicker, but the amount of times that we see the market opposite from what it did on Monday, especially during options expiration regular way, which, by the way, we're in this week, regular way OpX. We have PPI, CPI this week, not in that order, the reverse order. That adds volatility or a component of volatility to the market. Why is that? Because most everybody, from an investor to the traders out there, are hanging on whether the Fed is going to reduce and cut interest rates 25 basis points, 50 basis points. The next meeting, Jeremy Siegel's calling for an emergency rate cut last Monday. It's the Market wagging the dog, the tail that wags the dog. The Fed is the dog, the market is the tail. The market participants make up the tail. We have the yen carry trade situation. Bet your bottom dollar the Fed and central banks around the globe will have to intervene / get in front of, get involved with the yen carry trade unwinding situation. Is that going to be a one-shot wonder, a one-day or overnight situation like last week, or will that be something that persists? Is that something you can sweep under the rug right away? Time will tell. The yen carry trade. Put it on a sticky note. So what does this schematic look like going forward? Well, here's a couple of concepts that we can watch out for. Clean up the chart. We don't need the fibs anymore. Your zone is right up in this area. So let's just say, for argument's sake, this was a leg A down, and this could be a leg B up, and that will resume, or that will begin a C leg in the lower direction. And this one, we can actually use the arrow for this because this would officially complete below the low of the original A leg down. That is your next wave or leg down. How long can this B leg take? Well, it could be fast, it could be not so fast. We don't really know. It could take several weeks, or that could be it. Tomorrow, you're in an on-time situation. Is it going to be long drawn out? Is it going to be quick and painless, or painful, I should say? Well, consider this. Just like you had a potential A, B, and we're yet to see the top of B. We don't know where the top of B is just yet. But you can also have inside of that another micro level pattern that looks just the same. You can have leg A up off the bottom. Leg B is a retracement of leg A, and then you have leg C that completes higher than the high of the A leg, for example, into the convergence of these moving averages, filling a gap up here. Looks like it's going to fail one or two times in here, sucking the shorts in, and then they issue pies in the face on a short squeeze on the completion of the C leg. I've seen that many, many, many times. Read that book before, been to the movie, watched the trailer. Kind of gives you an idea, because even if we get that A, B, C and they complete up here and we have a better retracement, let's say up at the 618 or even higher, that's where I think another leg down will ensue anyway. So now you get the picture over the next several weeks to couple of months into the election period, maybe beyond, looking for volatility to stay in the market, and eventually in that time frame looking for another leg lower. The question is, from where? From a shallow retracement dead cat bounce 1 week or so like we just got, or from a more prolonged retracement making traders believe that the correction is over? It's going to take more time than just a week or two of a dead cat bounce scenario to do that. So from a market psychology perspective, trader psychology perspective, if you want to make everybody believe that the correction is over, it's going to take some more time. It's going to take 2, 3, 4, 5 more weeks to suck them back in, push the market up, go back and forth for a little while, get to an area where they start believing the correction is over, and new highs are the more likely near-term target than another leg down. Write this stuff down, put it on a sticky note, or mark the video, subscribe to this channel, because this is a place where you can learn stuff. How about a lazy swing trader automagical algo system intermission? Real quick. Last week, the system, she, buys Take-Two Interactive, TTWO. 137.60, trade alert issued. Alert goes out, text and email. 137.60, it's on the watch list ahead of time, so you know it's coming before the alert anyway. Risk-free, emotionless trade. Why? Because today we got the gap higher open. They even did it in the pre-market on Friday, but they never did it during the regular session. Up about 8% from entry. This was an aggressive first target, meaning we were looking for a big chunk, but that's because she was down a lot. You take it into an account. The baby was getting thrown out with the bathwater. We got a nice bounce back, nice profit in just a few days in Take Two Interactive. Risk-free, emotionless trade going forward. Lazy swing trader, automagical algo system. You think that was slick? Wait till you see inside the numbers today. Bit of a bonanza from a live room inside the numbers perspective. We're going to go over the numbers. I'm going to highlight a few important things and then we'll move on. What I urge you to do is pause the video, read the notes, go back to the chart to double check the work. We have an early pivot, 532.75. 5-minute chart, right of the vertical is today's activity. They spiked the pivot today. They spiked it pretty good early on. You know, there's no doubt something was going on here around that number. Even into the end of the day, they had to spike it right back to close above that number. And you can see they kept spiking it, but they kept getting rescued back above that place. Now, you can make a case for other stuff, but I had that as a pivot this morning, and they spiked it pretty good, but it's certainly even a little bit lower, had a good snapback situation, and they hit the target on the upside. What do I mean by that? Well, 535.70 was overhead resistance and the next magnetic place. This is all on the board at 0 dark 30 before most people even had a cup of Java. Where's high of day? How about 535.70? There are no accidents nor coincidences. We'll give that one a funny how that works. Remember, pause the video, read the notes, go back to the chart, and double check the work. 835, it's still kind of 0 dark 30 for some. 535.70 up to around 537 is overhead resistance. They shouldn't be able to blow right on through on the first run up there without a pullback type situation. And then the what if, but we didn't need the what if. 921, no change. 535.70 up to 537 is overhead resistance, and if reached sooner than later is an opportunity for a scalp short with potential from within that zone. 532.75 is the pivot. 532.75 is the pivot. If they drop them on an early shakeout operation, should get a bounce around the pivot, give or take. Below 532 on candle closes begins to look different, So I'm accounting for somewhat of a spike. Now, they didn't get down to here, 530.70. That was where the door would open to if they stayed below 532. And just so you can see from a 15-minute chart perspective, they didn't stay below for very long, but they did spike the pivot a little bit today. Today was the revisit the pivot or visit the pivot, run a test of the pivot, bounce back in the other direction trade. Pause the video, read the notes, go back to the chart, and double check the work. Nice trade for those that bought the pivot and the spike of it above high of day, and the door opens for 535.70. And here you can see the target becomes 535.70 on the long side. 535.70 up to the next part of the zone is the resistance zone. Traders riding the tape up to the resistance zone need to be aware of the resistance zone and make sure there's an exit up there between the target resistance zone. We're talking about the long trade. So you buy the long trade telling you where to exit, and then some traders took the short at 535.70 and got paid handsomely. Back to a 5-minute chart. How did they get paid handsomely? Because the market spiked it by a penny or two, I think 3 cents, and collapsed back down within basically a half an hour, 20 minutes. Where was the exit? Back at the pivot. If you're not in the live room, you're missing out. Write that down. Traders that are in the live room inside the numbers, help a brother out. Post it under the video if you're finding success in the live room. Are you making money? Is this a place to make money? Is it a place to learn how the market works and use it to your benefit indefinitely into the future as long as you want to do this? Is that the case inside the numbers and in the live room? Help a brother out. I'm not the brother. All the other traders out there that are trying to make it are the brothers. Help them out. Tell them whether this is BS or not. Pause the video, read the notes, go back to the chart, and double check the work. About Qualcomm and Coin today, those were the only two on the board. Let's go take a look at the charts, see what happened. Forthwith. What do you see this in Qualcomm? Check this out. This number doesn't exist. It was the first number, 160.60. Why doesn't it exist? Because Qualcomm opened the day below it. That's part of the rules. Opening print, 160.35. That number's off the board. Second and third number become the zone. Little bit wide, but we have an expansion of volatility. Adjust risk accordingly. Low of day happens to be 157.42 against 157.45. Rocket ride back in the other direction. How you doing? Thanks for playing. They even gave you a buck off what becomes the first number before going lower, 159.45. After opening below, first number's off the board. This becomes number one, and they gave you a buck in the matter of seconds right when they hit the number. How you doing? Meaning we had plenty of money made from members in the live trading room and inside the numbers. About Coin today, 190.95, 188.52. Two numbers up on the board. Came into both, came into the third, spiked it by a few pennies, and did what? Repeat after me. Ripped it back up in the other direction. Where have you heard that before? We'll give that a funny how that works, and also issue a do you like them apples commentary. 197.69 high on the rip it back up in the other direction trade. If you just take average of the two numbers, you're looking at an $8 rip in what accounts to be minutes. A lot of participation today. Traders like to trade Coin. Room bonanza in Coin from several traders that picked it up down there. Well done. Really, really nice way to start the week. Whether you had the double barrel trade in the S&P, whether you had one of the two or three, what have you. Qualcomm, Coin, for the other things that were traded in the live room. Nice way to start the week. What's going on over in Camp IWM? My favorite market-leading indicator, down almost 1% today. So the spiders were flat. The S&P was flat for the most part. Rounding error, 28 cents. SPY was up 28 cents. It's a rounding error. IWM was down 0.9%, $1.86. That's not a rounding error. My favorite market-leading indicator, as you can see, the dead cat bounce was petering out, at least for today. It's my favorite market leading indicator. We're going to jot this one down. It's a puzzle piece. It's on the table. By the end of the week last week, in terms of the weekly chart, they bounced right back to close above the weekly chart 20-period moving average, but have yet to fill that gap up here. What's the likelihood they don't, won't, or can't fill the gap up there before going much lower, other than the fact that there's no rule that says they have to fill the gap? Just from a we've seen this before perspective, what's the likelihood they leave that gap alone? We'll find out sooner than later. By the way, I forgot to bring up the weekly chart in the spiders. Same routine. You can see where they recaptured after opening the week considerably below everything on the Monday morning flush out last week, below the trend line, below the 20-period moving average, all the way down there. The opening print was down here for the week, and they rallied up to close back above the 20-week moving average and fill that gap on the weekly chart already. That's a bullish sign in and of itself. That's a reversal candle on volume in and of itself. You take it at face value and you move on. Then you have the folks down at the transportation department. Take a look at the daily chart and you can see where they are in relation to the moving averages. The trend is your friend. You're below all the moving averages. Tried to recapture them after opening the week below everything last week. Recaptured them intra-week. Couldn't close above them but one day just by a fraction. And then gave them up, including today, by the end of the week. Of note, puzzle piece on the table. Second favorite market leading indicator, a number one canary in the coal mine. Also down today. Not more than the IWM, but 0.5% nonetheless. Another puzzle piece also on the table. Qs, much of the same position as the spiders, trying to work their way back to the 100 period moving average. You have the same like position we talked about in the spiders. They're a little bit ahead of the power curve in terms of the bounce, but we're also in an on-time type of situation, not only in the spiders, but across the board, so the Qs included. Better spot for a bounce in the Qs is filling the gap up here into this moving average convergence up here close to the 20. Maybe by that time you're at or even above the 20 period moving average. The 20 will creep down each day. This gap is stationary, and depending on when price gets up to fill that gap, you could be filling or completing or touching, spiking through / testing the 20 period moving average. Financials, touch of a down day, 0.5%. Again, same routine, same bounces we see in the Qs, the S&P, the transports, the IWM, similar, not necessarily exactly same as IWM, but it's similar or same to most everything. So there's no new story. We can move it along and take a look at Smashmouth, which again, same routine. Up about 1% today, a little less than 1%, couple of bucks, but the same or similar bounce to most everything else. We don't need to recreate the wheel. And as such, have I told you how much I appreciate each and every one of you? Without you, these videos are not possible. That is true and accurate information. We're pulling the ripcord here today. I am David Frost, My Strategic Forecast. Thanks again for tuning in to another episode of Common Sense Market Analysis.